Hey everybody, welcome. Russell Moore, dedicated to financial literacy. Welcome. It's Saturday morning. I decided I was going to do a video. Remember, my channel is for newbies, new investors. So I thought I'd do a couple of videos, 2 or 3 videos on the fundamentals, beginnings, for those that are just starting and you don't know what to do concerning the stock market, but you want to invest, but you don't know anything about it. This is what you want to watch. You want to watch this. You want to watch the next few videos. I think it'll give you some, at least some beginning knowledge to get you started. But here's what I always say. What's my quote? If you don't learn, you don't earn. Tomorrow's earners is today's learners. If you don't lead, you don't read. If you don't read, you don't lead, I should say. If you don't read, you will not lead. Tomorrow's leaders are today's leaders. Are today's readers. So, man, I messed that up really bad. Tomorrow's leaders are today's readers. Tomorrow's earners are today's learners. All right? You don't learn, you don't earn. All right. Let's start. We're going to jump right into it. Be sure to hit the subscribe button, the notify bell, and you'll get more content in the future. All right. Why are stocks a good investment? Number one, I would say, why are stocks a good investment? I would start by saying this. It's ownership. Owning stock means you own a part of that company. In fact, that's one of the definitions of a stock. A stock is ownership in a company. A share is you take your cash money or Bitcoin. You take your cash and you purchase a share. And now you have a share in that company. What do I always, a practical example is a pizza. The pizza represents the company. The slices of pizza represents a share. And so if you take a slice of pizza, you have a share in that company. Okay? You pay money, you get a slice of pizza. All right? So stock ownership, you own. The other reason why I would say why stocks are a good investment is that stocks have been the best investment over time in the last 75 to 100 years, you guys. An average, and if you have a stock portfolio full of equities, you're going to average 10.5% yield every year. 10.5. All right? Why is that important? Bonds, commercial bonds, you may get about 4.5. U.S. Treasuries, you'll get about 3.3. Well, inflation's 3.3. On the average, it's about 3.3 every year. So if you got a bond that's 4.5, you're only making 1% because inflation is going to offset that. And if you have a U.S. Treasury at 3.3, 3.4, lately it's been up to about 4%. But inflation's going to eat into that, right? So you basically will break even. Inflation versus U.S. Treasuries. And then when you add taxes, you're at a loss. At least with equities, of which the stock market and by purchasing stocks, you're going to at least get about 6 or 7% annually. Okay, you'll lose some on inflation and taxes, but you're still going to end up with about 6 or 7% gain. Are you feeling me? Are you guys feeling? Are you feeling a brother? All right. So that's why. Those are 2 reasons. Ownership. Number 2. It's past the test of time. You're going to average about 10%, 10 to 10.5%, 10 to 11%. All right. Okay. I went over what is a stock. I also went over what's a share. The other thing that I want to talk about is how do you make money, or how do you make money owning stocks? That's one of the most important things you want to hear. It's like, okay, I don't want to just invest to invest. How do I make money? Well, through capital appreciation. That's one. Capital appreciation is say you bought the stock at $5. The stock is $5 for every share. Because remember, you got to purchase shares. You purchase 5 shares at $5. That's $25. Say those 5 shares. Say the price goes up from $5 to $10. If it goes up to $10 and you have 5 shares, that's $50. You just doubled your money. So it's capital appreciation. That's one way that you make money. The other way is through dividends. A company, if they're prospering, they're doing well, and they're profiting, and their earnings is up, and the margins are up, and they're making money. Many times a company will start giving dividends. They'll divvy out some of the profits to the investors, and you can be a part of that. Yes, even you. This is not just for what's called the preferred stockholder. It's also for the common stockholder. What's the difference between the two? Preferred is usually like the CEO and the executive and those that are on the board. These are people that have had a big stake in the company and the founders and all of that. And then you have your retail investors, which is us. Those are usually called what we call the common stockholder. Okay? Now, if the company goes under, the preferred stockholders are going to be taken care of first. They're going to liquidate, and then that's when they're going to divvy all the profits. And if there's anything left for us, then they'll take care of us. But we're not priority. Okay, so that's the difference. Preferred, common. One of the ways I try to look at it is in England, if you're not part of the royal family, you're called a commoner. The royal family, they got a status and they got prestige, they got money. But then the everyday person in England, the citizen, is called a commoner. So that's one way you can look at it. Preferred, commoner. Okay? Common. All right, common stock. Why and how a company sells stock. Why does a company sell stock? And one of the reasons is selling stock is a great way to raise money. So sometimes a company wants to raise money. They got some R&D going on. They're developing a new product, a new service, and they need money, or they need money to expand. They want to go overseas. They want to go to another country. They want to go global. So they say, hey, we need more money. So that's when they'll have what's called an IPO. Everybody say IPO. IPO is initial public offering. It's usually done by an investment bank. And I'm probably getting ahead of myself a little bit. I wanted to talk about this on the second video, but I'll go ahead and touch on it. An IPO is developed by an investment bank. Usually somebody like Goldman Sachs, Chase, JP Morgan Chase, UBS, another investment bank company, B of A, Wells Fargo has an investment division. And what happens is they hire analysts. The analysts are the ones that are helping these companies get their IPO. And so get their IPO together and then get them out public so they can sell shares. And so that's one of the things. And then going public, it causes them to raise more money. So a lot of times they want to expand. That's one of the chief ways. And so they'll go public, and then you purchase, and you'll purchase stock in that company. Now you've given them money, so now they can do other things. An example. Let me give you a prime example of that. McDonald's in 1967, I believe, McDonald's started. They went public. I think it was $22. If you would have invested about $1,000 in McDonald's in 1967, $1,000, right? With all of its expansion and how much money it's made over the years, and I think the last estimate, I think you would be around anywhere between $5 to $6 million if you just bought it. 2200. I think it was 2200, somewhere around there, between 1500 and 2200. If you would have bought it, spent 2200 when the McDonald's first went public, and just held it, didn't do anything. Maybe add some more shares later down the road, but pretty much you'd be a millionaire today. You'd be a millionaire. So What do people mean when they say market? What does it mean, the market, the market? Well, when you go to the store when you go to the store, right? What is it called? A market. A market is where they sell stuff. You take your money and you purchase food items, fruit, vegetables, canned goods, milk, cheese. Well, that's the same thing with the stock market. It's all kinds of companies. It's all kinds of fruits and vegetables there. And you purchase at the market. That's why it's called the market. All right? It's called the market. That's the reason. What is a ticker symbol? Ticker symbol is like an abbreviation. It's a code. Every single company that's public has a ticker symbol. It's usually surrounded by parentheses. Google is GOOG. Palantir, PTLR. Apple, APPL. That's called a ticker symbol. Okay, so if you ever hear the term ticker symbol, that's what a ticker symbol is for. That's all it is. It's basically a code abbreviation so that they don't have to write Apple. I mean, can you imagine if you had to write the company every time you did something with the stock? You had to write the entire name of the company. So this is just a short way. A ticker symbol is a short way to abbreviate. All right. Okay. I'm going to do a few more and then I'll wait for the next video. The New York Stock Exchange. The New York Stock Exchange was founded by 24 stockbrokers back in those days, and it was May 17th, 1792. New York Stock Exchange go back to a long way. A lot of people might think, oh yeah, the stock exchange. 1792 is when it was started. They signed the 24 stockbrokers. They signed an agreement called the Buttonwood Agreement, and it basically was the rules and the laws of when the stock market got started. Before the SEC. The SEC, by the way, the Securities Exchange Commission. It's basically the police. They regulate everything. They make sure that you don't get robbed and cheated by Wall Street. So they police this whole industry. So if you ever hear about the SEC, it's the Securities Exchange Commission. All right, it's ran by the federal government. All right. NASDAQ. NASDAQ started in 1971. And NASDAQ, the difference between NASDAQ and the New York Stock Exchange, the New York Stock Exchange had a physical floor, Wall Street. It still exists. People are on the floor trading. The NASDAQ brought in a digital era, computer networking. Now trading is on the computer. That's what NASDAQ was created for. All right? And mostly NASDAQ is tech, like Google, Microsoft, Oracle, Dell, those type of companies, Intuit, software companies, Microsoft. All those are on the NASDAQ. And lately, Palantir. I'm always pushing Palantir. Dow Jones, the Dow 30. 30 companies that are chosen by Wall Street editors. That's the Dow Jones. It's a mirror of the entire market. It's basically a copy. Basically saying these 30 companies in different areas and sectors, healthcare, tech, energy, hospitality, all these different areas represent in the Dow 30. But what it's saying is that we've taken a sample of the entire market and showed you 30 companies that these 30 companies represent the entire market. So this is kind of a mirror of what the entire market is doing. And then S&P 500 is the same thing. Standard & Poor's. Standard & Poor's, everybody asks, well, what is Standard & Poor's? They basically was a financial services company. Financial services is what Standard & Poor's is. And they analyze and they do a lot of research and stuff like that. So they're the ones that started S&P 500. And it's 500 companies, all different sectors, different areas, and they are a mirror. Basically, these 500 companies is a copy and a mirror and a copy of what's going on in the entire market. And you got to remember, the market is very, very large. It's not just 30 companies, the Dow. It's not just 500 companies. Thousands of companies, okay, are public. But everybody can't be on the S&P 500. So there's some criteria. I'm not going to go over all of the criteria in order to be on the S&P 500 or the NASDAQ. I'm not going to give you all of that. That's a good thing for you to Google. In fact, let me give you my statement that I always say as I get ready to close. I'm going to end this section at that one, the last one. And what do I always say? If you don't learn, you don't earn. If you don't read, you won't lead. Tomorrow's leaders are today's readers. Tomorrow's earners are today's learners. All right. I want to thank you for tuning in. Remember, hit the subscribe button, okay? And hit the bell so you can get more content. I'm going to keep this rolling. I'm going to continue to talk about and help some of the beginning investors, okay? Next, I'll start talking about where do you start? How do you start? You need to get an account, right? Where do you get an account where you can start buying shares? And do I have to have a lot of money? That's a question a lot of people have. You know, it's like, I got to have thousands of dollars to buy shares in the stock market. No, you don't. That McDonald's money that you spent that money on McDonald's. You know, you could have bought you a share with that. Yes, you could have bought a stock with that. The last time you went to McDonald's or any fast food, okay, any fast food you've went to. Say you spent $20. That's shares you could have bought in the stock market. Food for thought. All right, thank you. Have a great day and have a good weekend, you guys. Happy Mother's Day to everyone. Happy Mama's Day, man. I love my mamas. My wife wanted to go to a conference. I said, go, baby. You go have a good time. Here's some money. Enjoy, you and your friends. Enjoy. Stay in a hotel. Lavish yourself. I got my son. I got him. I got you. I got him. She's calling every other hour. No, she's not. Have a great day, everybody. Love you.